Ladies and gentlemen, welcome to an episode of Making Sense, a Eurodollar enterprise with Jeff Snider. We're going to be talking about reverse repo program purchases by the Federal Reserve. For those of you that have been paying attention, you know that several weeks ago, this incredible number was reached, $500 billion. And I asked Jeff to explain it. It was a very popular show. And looking back at that, what a quaint number. $500 billion. A day ago, it reached $750 billion. Jeff, mind-boggling. And you know what's mind-boggling, Jeff Snider, head of the global research team at Alhambra Investments. You know what's mind-boggling? The paper that the article that you wrote, you said that's not the most important part about what happened. So we're going to get into that, Jeff. But let's see, where should we see? Yeah, well, that's exactly what you state. RRP total was an astounding $750 billion from now 68 counterparties, up from $520 billion just yesterday. That's not the most important part either. Okay, what triggered this move, first of all, and then we'll get into why is this important?
Yeah, Emil, we got to back up a little bit first and go back to Wednesday. Wednesday was the FOMC meeting where everybody focused on the dots. Oh my God, there's rate hikes coming in 2023 or something like that. But in the minutia, the Federal Reserve made a couple adjustments to their what they call a double floor system, which is IOER and the reverse repo. The reverse repo is usually, or it has been up until this point, set at the bottom of the federal funds range, which since last March has been zero. So the reverse repo rate is the rate that the Federal Reserve pays counterparties to borrow their cash. So if you're a money market fund, you've got excess cash that you can't lend in the repo market, you don't want to lend unsecured in Fed funds because the Fed funds market is basically dead. You can go to the Federal Reserve's window and say, well, you know, I'll give you my cash, you'll give me collateral. It's sort of like a repo trade. Therefore, you know, I'll take whatever the Fed's paying rather than do something else with the cash that I have. And so on Wednesday, because of all of this cash buildup that's going on, money market rates that are compressing down towards zero, the Fed is starting to get a little antsy about interest rates, money market rates, short end rates, maybe going beyond that lower zero bound threshold and breaking out of the federal funds range, which is a big, huge no-no in monetary policy terms. So they raised IOER by 5 basis points to 15, and they raised the reverse repo, so it's no longer a floor. At least it's not matching the floor of the federal funds range. It's now at 5 basis points. So beginning yesterday, June 17th, the Federal Reserve paid 5 basis points on reverse repo, where for the year and 3 months before then it had paid zero. And so that's why so many counterparties went looking to park cash at the reverse repo window, because it now pays 5 basis points rather than zero. But that's not the whole story, nor is it, I think, even the most interesting part of it.
We're going to get to, we're going to talk about the zero lower bound. That's a very important concept here. But before we do, and by the way, audience, the article that you want to be reading along is the FOMC accidentally exposes itself, reverse repo style, posted on the 17th of June at Alhambra Investments. Let's go back to episode 79, Jeff. Audience, please go back there. This is episode 84. Go back and listen or watch that episode to learn a little bit more of the details. We're just going to go high level right now. Jeff, the mainstream orthodox view is this is working how it's supposed to be. There's too much cash. Therefore, this program by the Federal Reserve is sucking that cash out of the system and sending U.S. Treasuries back into the system. But in episode 79, we pointed out that this program started to percolate during two key dates, during moments when things started to go bad, meaning signifying it's not a cash too much problem, it's a something not enough problem. What was that?
Yeah, well, it can be. It's not an either-or situation here either. There is too much cash in the sense that money market funds are having difficulty parking their excess reserves or their excess cash in repo markets, for example. And so there is the case where there is more than enough funds out there in these markets that is suppressing interest rates. And therefore, in that sense, the reverse repo is working as it's designed, which is to act as a conduit so that that cash doesn't suppress money market rates below the whatever range the Federal Reserve has decided is its target. That part is true, but one of the reasons why there may be so much excess cash seeking out the Federal Reserve's reverse repo is that maybe in repo markets, money market funds, and other, not even bank participants, non-bank participants, whomever has excess cash, can't find enough collateralized borrowers in order to undertake the same sort of transaction. So it may be that they're not looking at the Fed's reverse repo strictly for, return reasons, a higher rate or a better equivalent rate. It's because the Fed's and its enormous SOMA portfolio is the only borrower out there with sufficient collateral to take up all of this size. And that indicates something very different. As we talked about before, that's more about, hey, the system may be collateral constrained and cash rich, which sounds like, well, no big deal, right? There's enough cash around there. Who cares? But as we've seen time and time again over the last 14 years, in many cases, collateral matters more than the cash does. And so if there's a situation where we can identify there's a collateral shortage, maybe not shortage, but scarcity, constraint, some sort of limitation that's impeding the normal market behavior, that's kind of what we need to focus in on. And that's really what the reverse repo can tell us. It can tell us, yes, there's excess reserves and it's soaking up and all that stuff, but it also might indicate that counterparties with cash are having trouble finding usual borrowers who have the collateral to engage in these repo transactions.
As our discussions and interviews with Professor Carolyn Sissoko and philosopher Daniel Want pointed out, we're in an era where collateral is very important. Before 2007, it was cash that was important, right? You didn't need the collateral, and that's a sign of trouble, of stress, that the system is struggling. So yes, collateral is very important right now. And as we talked about in episode 79, some things went bad right when this program started to be used. And one of those things that went south, pear-shaped, was that FedWire turned itself off for several hours on the 24th. Was that right? Or the 25th? 24th?
24th of February, yeah.
Well, Jeff, guess what? You wrote an article on February 8th, not after February 24th. On February 8th, you were writing, hey, guys, keep an eye on RRP. And that's when you brought up the lower bound, the zero lower bound. Here, this is what you said from that article. What we see in the bills auctions and their secondary market data is the same kind of sustained high demand. So much demand that over the coming weeks, it could push yields on them below the zero lower bound, again, and the RRP. Okay, why is the lower bound important, and what did the Federal Reserve do yesterday that now will allow us to see something new?
Well, first, what had happened since early January was Treasury bill yields tumbled, really. And it was all the maturities of the bills out to the 12-month. The rates on them just fell towards zero. And in many cases, over the last couple months, they had reached zero. At auctions and secondary market prices, we even saw an 8-week bill price in the secondary market at zero a couple times as well. So there was incredible, intense demand for Treasury bills. As we all know, as we say around here, Treasury bills are the best of the best of the best form of collateral. So they're already, by February, we're sort of like, our interest is peaked here because there's suddenly an intense scramble for bills. Now, part of that was supply related because Janet Yellen, faced with debt ceiling constraints and refunding mechanism and all these other things, there was going to be a sort of a bottleneck or squeeze in terms of supply, but still overwhelming demand for bills that pushed yields down further and further and further toward the zero nominal boundary, which is a constraint because, number one, at auction, as we talked about before, the government won't sell bills at a negative yield. So the lowest they'll go is zero for various reasons we don't need to get into here. So at auction, you're never going to get anything better than zero. So you can't overbid at auction is what I'm saying. However, in the secondary market, you can go below zero. As we saw last March, that absolutely did happen. But to go below the zero lower bound in terms of nominal yields in the secondary market, it would be an incredibly desperate situation because nobody wants to buy an instrument willingly that's going to lose you money on a short-term basis unless you absolutely have to and have no other alternative. That explains why negative yields last March, the same as briefly in October 2008 too. So the zero lower bound isn't a technical constraint as much as it is sort of it's sort of a secondary constraint on the willingness of participants to essentially sign up for a loss on Treasury bills. However, it will go below the zero lower bound if conditions are bad enough. So if we go back to the last couple of months, what we see is that bill rates didn't go below zero. Does that mean that the RRP held them above zero and they would have gone below zero if allowed to? Well, we don't know, and you can't separate the two out because the zero lower bound and the RRP were set at the same rate. So you could make the case that, that was just the reverse repo rate at zero, soaking up the excess reserves and acting as a floor for everything. Well, what happened this week with the FOMC meeting on Wednesday, with the Fed raising the RRP rate by 5 basis points, they've essentially separated the zero lower bound from the reverse repo. Now that it's 5 basis points above the zero lower bound, let's see how Treasury bills in the secondary market react to that now, the distance between the RRP and the zero lower bound.
At his press conference yesterday, Jerome Powell said, quote, "The reverse repo facility is doing what it's supposed to do, which is to provide a floor under money market rates and keep the federal funds rate well within its range. So we're not concerned." I didn't add that last part, Jeff. He said, so we're not concerned.
Right.
I'm going to go back just a little bit in time.
Well, no, I think that's important too. Let's point out that from the Federal Reserve's perspective, they care about the federal funds rate.
Yeah, that's something too.
Their target is ridiculously still focused. It's so absurd.
They're
wild. Focused on a money market that's been dead for almost 15 years. And as they said in 2014, thinking about all this stuff, going through all this, should they transition to a repo rate, all this other stuff, what they said is they're worried that if they transition to a repo rate, the communications signaling to the rest of the public would be interrupted because nobody would understand. What they're really saying is you're too stupid to understand monetary policy signals if the Fed changes out of federal funds rate, because the federal funds market is completely, utterly devoid of a lot of activity. It's certainly not like it used to be. So again, highlighting the fact that Federal Reserve is focused on the wrong thing and for the wrong reasons. This isn't really about money, it's about signals. And that's really what they're saying is they don't want the federal funds rate to go below zero because that could signal to the public the Fed has lost control. And that's what Jay Powell was saying is that if we move IOER up 5 and we move reverse repo up 5.2, that'll recenter the effective federal funds rate. And we all go, congratulations, good job, Jay. Except the rest of the market says, we don't care about the federal funds rate. There's everything else that we need to worry about. The repo rate. How about Treasury bill yields? Where are they now that the federal funds rate or the reverse repo rate is now 5 basis points instead of zero? That might be a hell of a lot more important.
I'm going to read a line here from the Federal Reserve. It's in one of its academic theory papers, February 2015, and they're talking about these floors. So again, the point is the floor. Mr. Powell just said the floor, and here's an academic paper from February 2015. Quote, "In theory, as with the IOER rate, the overnight RRP rate set by the FOMC would be expected to establish a floor on short-term interest rates, particularly if overnight RRPs are available in sufficient quantity to satisfy demand at the overnight RRP rate. With such a facility in place," these acronyms, "overnight RRPs would always be available to counterparties as an alternative to other investments, so counterparties that can invest in overnight RRPs generally should be unwilling to lend elsewhere at lower rates." Jeff, before I show this graph, this was written in 2015. I feel confident in saying that if this was written in 2007 or 2006 or earlier, when central banks were central, we wouldn't see "in theory," "would be expected to," or "generally should." It would all be "they would." but they have had some bad experiences with floors. And I'm going to pull up the most recent floor, and you tell us what's happening to yields and where they are.
Again, it's one of those things that sounds intuitively like it makes sense, right? If the Federal Reserve is paying the X amount for to borrow your cash on a collateralized basis, why would you lend anywhere else for less than that, right? If the Fed is paying, say, 1% at the reverse repo window, why would you lend in repo at say 98 basis points? I mean, it's the same exact transaction, except in the secondary market with an unknown counterparty. So why wouldn't you? I mean, in theory, it sounds perfectly consistent there. You would never lend to anybody outside of the Federal Reserve at a rate less than the Federal Reserve is willing to pay, especially since the transaction is you're lending cash to the Fed and it's collateralized by U.S. Treasuries. I mean, it's about as safe as it could possibly be. And if they're paying you X percent, you would never do anything less than X percent. Except, as we know, throughout 2017 in particular, the RRP was repeatedly violated by short-term Treasury bills. Yeah, there's a chart exactly. And what that said was that, again, same situation. Why would you buy a 4-week Treasury bill when you could just park money at the Fed's reverse repo window and get so much more than the Treasury bill is paying you? So if you have a 4-week Treasury bill, just roll over a reverse repo for 4 weeks and get so much more. And what it tells you is that the Fed realized that, hey, there's other things going on here. But more than that, it shows absolutely perfectly clearly that there is value in especially Treasury bills over and above their return characteristics. So there's a utility here in Treasury bills, specifically Treasury bills, that isn't captured in comparing alternative investment returns. So the reverse repo isn't a floor in the respect that there are other ways in which these things get valued, especially Treasury bills. And as the chart you just showed before, what happened this week was exactly that. Once they moved the RRP up to 5 basis points yesterday, and this has continued today, by the way, Treasury bill yields actually did come in less than the reverse repo all day yesterday and throughout the day today, June 18th, because there is a value to Treasury bills over and above what is direct comparison lending at the RRP with the Federal Reserve. There's a utility and a value in them that you do need. We weren't able to see when the RRP was at the zero lower bound. So going back to what we said before, it seems like maybe there was a chance that the secondary market bills might have gone negative, if not for or might have gone below the RRP if not for the zero lower bound being in the way first.
Jeff, to conclude, we have this surge in activity. It seemed to begin when some other markets struggled, when the U.S. Treasury yields peaked.
Yeah, you were making this point, and then we kind of got kind of got off on a detour there. But well, yeah. No, and I think that's probably the more important point here is the implications of all of this collateral business. When we now see the collateral business more clearly, that Treasury bill yields are below the RRP, that gives us the sense that there's collateral constraint and value in the Treasury bills, shortage of Treasury bills, whatever you want to call it. And so that's why I think you can line up the long-term Treasury yields changing from reflation to anti-reflation at the exact same time, middle of March. Going back to February 24th, there was a little blip in the RRP after February 24th, but really middle of March, March 18th, suddenly long-term U.S. Treasury yields stop rising. They get out of reflation and start going into anti-reflation at the exact moment usage in the RRP started to go up. Now, we're not saying that the RRP is causing Treasury yields to fall. What we're saying is those two are reactions to the same thing. And it's the same thing that's captured in Treasury bills being priced at a premium that lowers their yield below the reverse repo equivalent, or what's supposed to be a reverse repo equivalent. There's a collateral scarcity issue at hand right now. And it's not an extreme one, but it's certainly one that causes, as we talk about all the time, what it suggests or causes is the idea that the system is maybe a little bit more fragile and weakened and less robust than it otherwise is said to be, which goes along with lower anti-reflation long-term Treasury yields, which are essentially the implications of that. What it says is that the chances of things going wrong outweigh the chances of things going right because it's a fragile situation, especially where collateral is concerned, and that over time, something could happen, even something very minor could happen to disrupt recovery and inflation and everything else before it ever really gets going, because that's exactly what we've seen time and time again. We have these reflationary periods where the fragility and weakness interrupts them before they ever get to where we all want them to go, which is full recovery.
That's what you wrote in 2017, in June 2017, the article, Chart of Last Week, in need of official address, when you were talking about this exact same thing happening in 2017 during globally synchronized growth, when everyone was in their bikinis and their swim shorts and on the beach and having a great time, and the future was wonderful. You said, fragility, we seem to need collateral, something might be wrong. Less than 3 months later, we saw our first spark. And then 2 months later, November and December, something started to smolder. And by the end of January, we saw flames. And in April and May, the curtains caught fire. And then, the next Eurodollar squeeze began. Jeff, is there anything that we didn't cover in this episode? I think we've got it, but if not, let me know. Otherwise, we're going to move on to U.S. Treasury yields.
No, I think we covered it. It's not an either or situation. There is money market funds with excess cash preferring to lend to the Fed. That's one reason why the use at the RRP window is so high. But I think we really can't ignore the other side of that, which may be collateral constraint and scarcity, which is now the Federal Reserve doing us an inadvertent favor by exposing this even more, raising the RRP rate above the zero lower bound. We can now see Treasury bill yields below the RRP, which, again, like 2017, tells you all you need to know.
So we talked about Treasury yields and how they're indicators of which direction the reflation may be going. Jeff, I don't know if you've noticed, a lot of people on Twitter are saying, well, we can't look to yields in the U.S. Treasury because A, B, C, D, E. And when this started? This started happening when the yields started going against the narrative. They weren't saying don't look to yields when yields were rising. In part two, we're going to go over a litany, maybe litany is too strong a word, a healthy list, a few bullet points of past experience that shows how Treasury bonds have been predicting correctly for years which direction the global economy is going to go. So stick around.